Thank you, everyone. I guess I'm going to start the session by saying, for those of you who have seen Game of Thrones, faster payments is coming. Now, unlike the series, it's not going to herald death and destruction, but what it does herald is a period of change in terms of how payments are actually going to work. So part of what I'll do today is paint a picture of the landscape across Asia in terms of what's happening with faster payments, but also importantly, what's driving the change. And I think we'll note there's going to be some differences between what's driving the change in some of North Asia and ASEAN as compared to Australia and New Zealand, but there's some really useful insights in terms of things that will help us prepare as it becomes a reality here. So the first thing I'm going to start with is talking about digital disruption. Now, at the last earnings release, 2/3 of the Fortune 500 companies actually cited digital disruption as either a challenge or an opportunity or both. And that means it's not just born digital players. We're talking about almost every industry citing that technology change is actually really pushing the bounds of their industry. Now, let me just make sure this comes through. One of the things that I will say, part of what's driving this is the broad adoption globally around smartphone technology as well as social media. And given I've got 2 teenage daughters at home, I can tell you that's thriving and it's unlikely to change. And what that's driving is e-commerce in a very significant fashion. And if we take a look at this right now, global e-commerce is about 2.3 trillion. Asia is almost half of that and growing at 25% a year. Now, that means that we're both the largest region globally and the fastest growing in terms of e-commerce. The interesting thing is as well is only 13% of total commerce or retail is actually occurring online, which means from a macro trend standpoint, we've got a lot of room to run in terms of where e-commerce is still going to go. Now, part of what that's doing, it's actually changing the payments landscape because it's actually, and we'll talk more about this, but it's actually changing in miniaturizing payments and increasing volumes. And we'll see more about that. There's a couple other points that I'll touch on. As we go through this between social media and platforms, and I think this was alluded to partially with the Alibaba examples, it is about the payment, but it's also about the data. And it's about the data within those ecosystems. And in many cases, the data is actually becoming more valuable than what historically has been the core business. And we'll talk a little bit about that as well as we go through. And as well, we should note, and we'll delve into a little bit, this is also changing the model for how some of these businesses actually work, and we'll touch on that. So if we look at this, and traditionally in a lot of our value chains in terms of how this used to work, you might have a manufacturer or producer. They might actually work with an exporter who would work with an importer who would work with a wholesaler, in the end would get it to a retailer, and eventually you would get to a consumer. And in that model, there was lots of moving parts, but what it also meant was for the manufacturer, typically they were dealing with middle parties who aggregated trades and actually blocked up, and typically they were receiving a smaller number of larger payments. In our world of kind of platforms that we're now dealing with, you know, whether it's the Alibabas or the Amazons or otherwise, the producer is now coming a lot closer to the end consumer in terms of how transactions are actually transpiring. A lot of those middlemen are gone. So when we talk about the miniaturization of payments, where we used to see that at the end at a point of sale, we're now actually seeing that in many cases directly to the producer or the manufacturer of goods as well. So some of your clients who used to deal with a small set of very large payments are now dealing with a very, very large number of very small payments. And that creates challenges, and how that works is different by market. Now, obviously, when we think about e-commerce in Australia and New Zealand, everybody's got a card. As a matter of fact, most of us have about 5 cards. And so we think of it very much in that respect. But the reality is in Asia, actually usually less than 10% in developing markets of people actually have credit cards. You know, that's not accessible to them. And really what you're typically looking at then is that it's cash on delivery, which I know sounds absurd. But in a lot of these markets, that's how e-commerce works. You order something online, you show up, and you have to pay cash for it. So very, very different. But what we're seeing is a leapfrog, and I think David alluded to this as well, is that faster payments is now becoming a mean for how, in a lot of these markets, e-commerce is actually happening. So that's both mobile wallets as well as faster payments, and often the two are connected. Now, I'll touch on the concept of an ecosystem, and for better or for worse, I've actually got an example with Alibaba, right? Because most of us, when we started thinking about Alibaba, we thought, okay, is this about Taobao? Is this about Tmall? Is it about consumers paying consumers, or consumers, buying from large branded businesses, or is it AliExpress? And those are very valuable, but I think the point that was made was that they look at it much more broadly than this. They're trying to drive spend and time on platform and monetize the data that comes out of this. And when we look at that, they've also created their own browser, which is one of the things I think is brilliant. Right? So they've created their own essential mobile browser. They know what you're searching, they know what you're looking at, they know what you want to watch. And with this, they're able to intelligently build out an ecosystem of layers around this of ancillary services, whether it's logistics, whether it's consumer finance, whether it's marketing services, of course, Alipay, which we all know in terms of facilitating the payments as well. But what they've been able to do is to get really smart about this, to say, based on your preferences, whether it's the traditional idea of saying, how can I provide you or serve you a service at the right time that I know that you're going to need based on your history, or even going in parallel. So if we take Ant Financial, which I think is quite remarkable, is, this was a domain that was ours. When I say ours, I'm talking about banks. Consumer finance was something we do. And historically, if somebody needed money, they'd come to us with an application. We'd run them against our scorecard credit. Hopefully most of us, it's all scorecard now for cards or personal loans, and we'd assess whether or not they were in that zone. The interesting thing that we discover is when you download and you are part of these platforms, not only do they know from a browser standpoint, but within their software development kit, if you're on that platform, they actually know from the photos on your phone, they can tell what kind of phone you have. They can tell what kind of phone your friends have who are sending you pictures. They can actually, from geolocation, tell you what neighborhoods you hang out in. Are you hanging out in expensive postal codes? They actually start to perform a profile of who you are as an individual without asking the kind of questions we banks normally ask in terms of what's your income. They're able to do this off a number of factors, and they've been able to actually step in and now build a very, very large business. As a matter of fact, I think their balance sheet's about $95 billion in the consumer finance space right now on Ant Financial by actually doing this a different way. And that's quite fascinating to me when I look at it and how powerful that actually is. Now, I guess the other thing that's interesting about this is the proof's in the pudding for them. If first year on platform for these guys, they had consumers averaging about 38 transactions. Fourth year, off of everything they've learned off you, you're up to 123 transactions. Very, very, very powerful. Now, I'm going to move off e-commerce for a second and talk about the regulatory environment. And I think, David, you've alluded to a couple of these elements, but I'm going to touch on them as one. Financial inclusion in Asia is a massive issue. We alluded to 10% have credit cards, maybe 60% have a bank account, 40% are unbanked. Financial inclusion is a huge priority, especially in the developing markets, of getting people into the economy, which usually means like a national identity and a fixed address. But that's a primary driver in a lot of markets. As is, and actually, I'll build the top and then come back to the bottom. We talked about cashless societies, and David referenced this. So first of all, for all of us, we know cash is a very dirty business. It's very time consuming, it's very expensive, but it's also a big enabler of the gray economy, right? So when we look at what happened in India with demonetization a couple of years ago, it wasn't just because it's expensive. It's because Modi was trying to get the gray economy back into the taxed economy so that that could actually be recorded and it could be invested, could be taxed properly, and build out infrastructure accordingly. So yes, it's expensive, but even in Australia, if you saw the latest budget, there were items there trying to actually improve visibility or transparency around cash transactions and trying to really close the loop on some of that. So when we think about transaction threshold reporting or PTR that's coming to New Zealand, a lot of this is aimed at creating greater visibility, so a lot of this does not escape. So Austrac and Australia aren't just getting it for themselves, they're getting it for the ATO. That's why the data is coming, and a lot of this is that move away from cashless societies. Open banking, I won't spend a lot of time here. We all know it's about creating APIs and its access, whether it's banks or fintechs. the end game here is there greater efficiency and is there greater benefit for consumers by enabling that kind of access so there can be more innovation on top of what we do as banks. Now, do we as banks have the rights to innovate here? Absolutely. But I think the idea is, there's a little bit of a carrot and a stick here that's coming with it. Now, how will it play out? We've seen what's happened in the UK. Is this a tidal wave or is this small? I think it's a little bit too early to say in my own mind. But the other thing that comes with this is we go more digital. Protecting customers, and specifically around privacy and identity, is becoming more and more critical. And that's actually a little bit in conflict with what we talk about potentially around open banking. And that's something that I think is still up for resolution, is how's that going to work? We're an industry that's been built on trust for decades in terms of how we manage private or sensitive data. There's a balance to be struck as this becomes open, and make sure that we actually get the right benefit while at the same time keeping the right level of protection. So when we think about this from a market response standpoint, what does this actually mean? We've got a desire for inclusion. We've got a desire to go cashless. There's a desire from governments to open up the banking system to enable more fintechs, more innovation. And we do have privacy concerns as part of that. But the market response, you see, especially in Asia, has been a proliferation of faster payments. It's been a proliferation of wallets, and it's been a proliferation of fintechs. Now, we haven't seen as much in Australia and New Zealand, but I think the example of if you go to Thailand and you see what's happening, and if you go to places and you see places like Line Pay, so it's not just the WeChats and the Alibabas. Every market has players that are arising. They're actually making significant traction in these space. So, it creates this environment where, as I said before, when I said faster payments is coming, the reality is in most of Asia it's already here. If we start at the top, you can see a number of the names, and this is an eye chart. Look, they're all there. All the major countries by 2020 essentially will have some sort of faster payment scheme. Now, there may be nuances in terms of, do they have dollar limits? Are they truly 365, 724, et cetera? But there's a lot of consistency in where we're going. Now, obviously, Australia went live earlier this year. Hong Kong is coming as well. We talked about Malaysia, Thailand, and we do have the Philippines and the Vietnamese government-driven initiatives that are coming here, and of course what we're talking about here in New Zealand as well. So this is now essentially in large markets becoming ubiquitous in terms of the environment around faster payments. So what does it actually mean? I'll give you an example first of what's happened adoption-wise, and this is the India example. So we talk about India as two things. There's IMPS, which is the faster payment system, and there's UPI, which is essentially the tokenization, or in NPP terms, which is how I think of it having kind of been on part of that journey in Australia for the last 5 years. It's the addressing service. So it's tokenizing your bank account information. So when you look at this, you can see it was launched in 2016, but you can see what happened or has happened volume-wise. I think we're dealing now on a monthly basis. It's taken off. We're now at something like, I think it's 1.7 billion transactions, 1.8 billion transactions a month on IMPS. Value roughly, I think 4.8 billion. Now that may not seem significant, but the growth rates we're now talking about, 22% in terms of value, 30+% in terms of volume. It's now caught up with and starting to outstrip the growth rates historically around debit and credit there. So it's become a real channel, and importantly, and I think this was a point somebody made earlier, it's not just about peer-to-peer payments. So now we're dealing with 22 million payments a month that are either payments from consumers to merchants or consumers to business within India. So we're now seeing all the large corporates now saying, how do I turn this on as a channel? And what's interesting for us, and Citi, a lot of these ones we're dealing with aren't just saying, how do you turn me on in one country? They're saying, how do you turn me on across Asia when I do this? Because in the end, the customers are demanding which way they want to interact. So this is interesting, because if you look at, and I'll declare I'm part of the NPP board, and I guess I've been involved in that journey since it was the Real-Time Payments Steering Committee back in 2012. We've not yet hit the full network effect like India has. Clearly we've launched and gone live. Not all the banks are fully there yet, but I think it's interesting. You can see what the opportunity looks like when critical mass does achieve and how quickly those things ramp up. Now, I'll touch on NPP. When NPP started, the RBA, well, this was kind of, I think most of you probably know the history. We were led there, and there was definitely incentive, which was if you don't build it, we'll build it and mandate it. But it came off the back end of their consultation and study around real-time payment systems. And they said there's 4 things that we want. We want 7 by 24, 365 days a year. We want, because our system at the time was 5 days a week, and even at the time, fewer actual windows. They want real time in terms of payments. They wanted richer information, and we'll spend some time on that one because I think it's really important. And they wanted that proxy or addressing service instead of saying BSB and account number. Now, a lot of those themes are consistent with what we're seeing across almost all these systems in Asia and what's driving adoption. I'll drill down on a couple of them because a couple are table stakes. Real time, that's table stakes. That's what almost every one of the systems is creating, is real time or near real time. But push and pull payments is, I think, an important feature. It's important to be able to pay somebody fast, and certainly from a peer-to-peer standpoint, that's often what we think about. I think the point about a request to pay, this is something we're seeing actually exploding in terms of from a corporate use standpoint, and what's enabling both online commerce and otherwise is people having the ability, or corporates having the ability, to send that request through the messaging system for you to receive it, your bank to receive it, you to get it, be able to get on with a one-time password or two-factor authentication, be able to authenticate it, and know that that payment's irrevocable at that point in time. That's very significant. Obviously, direct debit type capability for the recurring payments is important as well. So it's not just a one-size-fits-all. And I think some of the schemes that have built one version are, as we know, we're looking at how those things actually work going forward. Tokenization is a must in this space, and this is when we talk about that kind of addressing service. And one of the reasons for this is when we look at a lot of the industries, a lot of them have great difficulty, maintaining beneficiary bank details, which actually forces a lot of people into checks and things like that. Having the actual addressing type services or tokenization is a key enabler to be able to eliminate some of those things like the dreaded check, which is still an incredibly expensive and outdated. The only person I know who still does it is my mother, and I don't think that's ever going to change. Now, richer information, and David alluded to this as well, a lot of the challenge in non-peer-to-peer payments is the actual movement of the payment and the associated information. And it's often about enabling business processes. So when we think about this, if you take an example of like a fast-moving consumer goods company selling to a grocery chain who maybe invoices 100 different locations, but what they receive back is one payment with all the short pays taken about it and insufficient information through the ACH stream to actually reconcile that. Imagine a world where they can actually get all the data at the same time, so that becomes a straight-through process. The business efficiency that gets created is really significant. Finality, again, we talked about the need for irrevocability and global standards. I won't go too much deeper, as we know. I think in the end game is these systems will integrate. And we talk about cross-border, that's where standards are going to enable us to. Now, I'm just conscious of time. I've got a couple of use cases. Instead of going through all these, I've got 3 I'm going to go through in specific. I think one of the framework or points that I would make on this is everything made for faster payments? The answer is no. I mean, I would start with the idea of, is there actually a customer need in this scenario for it? I would also look at, is there a business case that actually sits behind it? Because, to be frank, in very few instances is a faster payment necessarily going to be cheaper than a traditional ACH payment. But as substitutes, and some things we'll talk about, that works as well. Or is there a government mandate around some of these things? So I think there's a couple of different lenses to look at. But I'll walk through a couple of specific use cases. I'll just go ahead and build these out to begin with. So easier and faster payments. And this is a question about, I'll take an example of the insurance industry. The insurance industry is a great industry for disruption, right? Well, the insurance industry, I think, pays something like 27 billion in claims in Australia every year. It's about 3 million checks. And again, we reference, they can't maintain all the beneficiary data, so they send checks. Now, that's very, very expensive. The average cost of a check, I think they're saying somewhere around $17, and that includes the mailing, the missed checks, the returns, all those kinds of things. So it's an expensive process. But imagine a world where, in a real-time payments standpoint, they'd have the ability to actually get online and instead of sending you a check, being able to use your tokenized information, which could be, again, a mobile phone number, an email address, your tax file number, whatever the standard is for each of the systems, to be able to actually send you and immediately disperse not only the check, but the related claim information that used to be included in the insert in the mailer. You're able, at a customer level, you're able to receive that real time and be notified by your bank that it's in your account. So you're dealing with an experience which is not only a far cheaper experience, but from a customer experience standpoint, is dramatically better. So this is one of the industries where faster payments is essentially a no-brainer. Another, and in this kind of thing, if we assume roughly at an industry level, those costs that come out, could the industry be saving north of $30 million a year? Absolutely, because it's essentially about a third of the cost of actually processing the physical checks. Another example that I'll build through quickly is about airlines. So right now, if I'm buying a ticket online in an airline, typically I'm going to pay with a credit card. Imagine if we had the request to pay capability, and as you're on and you're checking out, you get the option for request to pay. Your bank gets sent a message for request to pay. You see it, you go on the line and authenticate it. When the merchant's bank or the airline's bank receives the funds, they're able to notify the transaction's complete, and essentially your tickets are released. Now, why is that important? Because right now this is all done by cards. Globally, airlines spend $7 billion on credit cards in terms of merchant service fees, and $1 billion on fraud. So what's the opportunity for that industry to adopt real-time payments and actually drive a dramatic savings? Now, I think they make something like an average of $8 per passenger, so any savings for them is going to be really significant. Potentially they could share it with the consumer. That may not transpire, but at any rate, it's a theory. So that's another interesting use case. The last one I'm going to touch on in the last minute that I have is going to be kind of your little by-the-side-of-the-road vendor. Because one of the options that you have is, and this is where QR codes come in. So if you move away from credit cards, one of the challenges may be about reconciliation. So request to pay gives you the ability to do that because you can load that with a reference point. But if it's not a request to pay, how does that happen? And that's where QR codes are starting to come in some of these Asian markets, where essentially when they're actually presenting that as an option, they're generating a QR code. And in some of these cases, the consumer is able to open their banking app, scan that QR code, and it automatically generates then a real-time payment that can then go and automatically be reconciled by the merchant and essentially go straight through and be applied into that account. Now, I mean, what's interesting about that is if you think, and obviously we've been regulated in Australia in terms of the merchant service fee. I think we're now, on a weighted basis around 55 and capped at 80, but a lot of markets, that's still 150 to 200 basis points. So if you ran through an example of Singapore where 95% of e-commerce transactions are cards related, the estimated cost savings potentially, you could save 80% on this. And it's a $5.5 billion market now. It's forecast in the next 10 years to be a $20 billion market. So adopting some of these kinds of technologies is a dramatic cost savings. Now, and and I know, a lot of those merchant service fees end up getting passed on to you and I in terms of surcharging as it is. So I guess in the end, faster payments, really it's not just coming, it's here. There's a number of reasons. E-commerce is clearly one of the things that's been driving this, but it's not just applicable to e-commerce. I think the regulatory environment is also very much a strong fit for why this is coming now. I think the reality is for us, while those drivers around inclusion are probably different than a lot of North Asia, there's still going to be very real use cases beyond splitting the fees at the pub or splitting the tab at the pub that are going to change the way we serve our corporate clients and the way our consumer clients actually interact with one another and the bank. So hopefully there's been some food for thought here in terms of use cases and things to think about. Thank you.
Thanks,